With rising inflation, bank failures, and massive layoffs across multiple sectors, the future of the economy remains uncertain. It's no wonder the central banks have been getting prepared by stockpiling gold. At ITM Trading, we have spent over 27 years building a team of seasoned researchers and analysts who can help you prepare for any financial crisis. Our experts are ready to provide you with proven strategies to safeguard your wealth and assets in the event of an economic downturn or currency reset, which is frankly inevitable. Don't wait until it's too late. Schedule your free gold and silver strategy call by clicking on the link in the description below.
But I think the main reason why we haven't seen one, if I could point to one, would be the fact that we just haven't seen effective interest rates starting to rise, meaning as we see debt obligations begin to mature and institutions, corporations, and sovereign institutions have been forced to reissue those maturities or those instruments at a higher interest rate environment. I think that's really what going to create the impact of monetary tightening is starting to actually work, which tends to work with a lag, but it's starting to really impact markets overall.
Maneco 64, home of alternative economics and contrarian views. So we've got Tavi Costa today. He's the portfolio manager at Crest Capital. We have had him before many times. And this is, of course, the fourth in a series of Christmas or holiday special interviews. Tavi, welcome to the channel again.
Thanks for having me. Looking forward to this, Maneco.
Yeah, thanks for coming. And just wanted to ask you, today, of course, is we're just an hour away from the Fed decision, and so we don't know what they're going to come out with. They're probably going to keep rates unchanged, but most people are looking at the dot chart and everything. I wanted to ask you your view of what happened in 2023 and whether your opinion of the theme that you've had, and I've kind of had as well, that hard assets will outperform paper assets in the coming years, is still there.
Absolutely, and I think it still is, continues to develop towards that direction. We had a very turbulent bond market in 2023, also in 2022, and we've had people come to the conclusion that issuances of treasuries matter, which was something that at the beginning of the year wasn't really a topic being discussed. I would also mention the fact that we've had gold performing very well this year. We had a narrowing leadership of the market overall, and the economy is starting to show some signs of weakness. And labor markets, to me, are one of the most important parts of the market in terms of the economy, I guess, that are starting to show some of those signs. We've had unemployment rates going above its 200-day, or I should say a 2-year moving average, which is an indicator that has always led to a deterioration in labor markets. We had job openings beginning to really fall. And if you looked at the number of those coming from government jobs relative to the overall number, you're going to see that it's also one of the largest numbers that we've had since prior recessions. In other words, private companies are not hiring as much as the government is. And so that's usually a sign of a recession in the horizon. We also had other problems regarding overall, even number of folks that are employed for over 15 weeks or so. And that is starting to tick up as well. And then when you see that, is usually a sign of a recession ahead. Manufacturing is something, a segment of the economy as well, that has been showing some issues. I believe ISM manufacturing is below its 50 level for over 12 consecutive months. That's also something that only happened during recessions. And so, there's quite a lot of, I call this a profusion of macro indicators pointing to a direction of a hard landing. And we haven't seen one just yet, right? And everyone talking about the soft landing narrative, which has become more prominent. But I think the main reason why we haven't seen one, if I could point to one, would be the fact that we just haven't seen effective interest rates started to rise, meaning as we see debt obligations begin to mature and institutions, corporations, and sovereign institutions have been forced to reissue those maturities or those instruments at a higher interest rate environment. I think that's really what going to create the impact of monetary tightening is starting to actually work, which tends to work with a lag, but it's starting to really impact markets overall. And so it is my view that that's probably what's going to be the next development here. And so when you looked at VIX and other volatility instruments trading at multi-year lows, it makes it very compelling to be, at least protecting yourself and hedging against a volatility event eventuality. And so I think there's quite a lot of reasons to be concerned about that. And as you mentioned as well, the opportunity in the hard assets remains the case, and I think will continue to be the case for the next decade. I think you're muted.
Okay. Yeah, so as you can see here, what you just spoke about here, and this is quite incredible where VIX is and how much the Fed has tightened. We could see. Do you think something might happen in the next few months in the beginning of 2024? Because it's I think it was April 2022 that the Fed started hiking, so that's about 2 years.
Yeah. Well, look, the Fed put out a paper making the case that monetary policy works with a 24-month, between 20 to 24-month lag. We've been about 21 months into the hiking cycle, so we're right in this range right now. And, it takes time for all that to kind of impact not only labor markets, but other things. And it's much easier to tighten monetary conditions when labor markets are so robust, but when you start seeing, issues with, as I mentioned, regarding that, it becomes much harder job for the Fed to continue to justify what they've been doing. And so, we've been living in an environment of what I call the trifecta of macro imbalances for a while, and I still think that's the case. Ultimately, central banks do have to go back to restoring financial repression and really allowing hard assets to perform well relative to fiat currencies and even very expensive financial assets overall. So that hasn't really changed, and so all those things are kind of coming together right now. And I find it hard to believe. Today it's going to be an important press release, I believe. I also think that you're seeing yield curve inversions actually deepening even further into this inversion problem that we've had for the last 20 months or so. And that's something that also has predicted recessions in the past many times. And so you can play against history here, but it wouldn't be my playbook. It certainly wouldn't be the way I would approach this. I would approach this with caution, and I would certainly consider the risk of how tightening conditions can actually create volatility to start increasing very soon. And the reason for that is because cost of capital being higher, causes the discounting mechanism of businesses and present values to become more volatile as well. So it becomes much harder for you to justify the valuations of businesses as you have interest rates staying higher for longer. And so, I think that's also going to be the main factor that creates the volatility event. And ultimately, the Fed has to cut interest rates. And once that happens, it's not positive for risk on assets, as a lot of people are mentioning. Go back and see history of every time the Fed cut interest rates. That was the beginning of a recession, beginning of the downturn. And so, a lot of people are going to get caught up in the wrong way here. And, this is one of the most speculative environments I've seen in my career. And unfortunately, a lot of people are seeing this as still as an opportunity to invest in a banana republic kind of environment. But there are much better ways to play that idea, which is hard assets that are historically cheap today.
Yeah, I like this chart that you put out here, the golden cross. And of course, I remember, that Sunday night, it was Sunday night here in the UK, I got a few messages from people, "Oh, have you seen gold?" Said no, it's at above 2100. And then, next morning it was already back below 2100. So could you go over this chart here for the viewers and tell them what you think about gold and the miners as well, of course?
Yeah, well, look, and we actually had a discussion, trying to have an interview during that time as well. And unfortunately, I was busy with other things and I couldn't come in. But what I thought about this whole situation is, first, triple tops don't work, right? Triple tops, technically speaking, is kind of what we have, and this is all technical terms that ultimately don't really matter. We're looking at a golden cross. Golden cross is just technically, again, when 50-day moving average crosses above the 200-day moving average. But as I said in this chart, fundamentally nothing has changed. And despite the fact that people have been spooked by the volatility in gold recently, what we're seeing is that two pools of capital are really buying, accumulating the asset. One of them is the central banks. Central banks used to own about 80% of their balance sheet into gold, and they own less than 20% today. So there's certainly a lot of room for that to increase, and we're seeing that already. Despite the fact that we had record purchases, we're still coming from very low levels. Number two, it has to do with the traditional investment strategies, and those investment strategies, they are just starting to allocate capital to gold. There was a good research from Bank of America the other day on a survey that asked financial advisors how many of them own gold in their portfolio, and 73% of them answer that they own 0 to 1% exposure. And so, the room for growth in terms of capital inflows is massive. And so, to me, when I think about, okay, we're on the onset perhaps of a gold cycle and a secular move in gold prices, immediately comes to my mind, what are some other opportunities I can get leverage towards that idea? Silver comes to mind. Silver is the first thing that comes to mind, indeed. Other precious metals come to mind too. Other folks like to focus on platinum, palladium, and so forth. But the third one would be the miners. I've knowing how distressed the opportunity currently is in this industry, to me, it's just a great setup to be taking a very long-term approach and unlocking value of a lot of those businesses that still look very attractive, fundamentally speaking.
Yes, and earlier today I was just looking at silver and thinking, we're at $22, 50 or 60, and 43 years ago silver was at 50, and in the last few years everything has gone up in price, and I find it amazing. It's a steal, I think, physical silver. The miners, though, is a different story. Could you tell the viewers the difference between the junior exploration, the mid, let's say, those that are more along the road to production, and the big companies that produce already, and what the risks are, and maybe also talk about like the geopolitical risks, because we're seeing, like in Venezuela now, trying to annex almost half of Guyana, which is the region there is rich in minerals. It's got oil as well offshore. So your thinking on that?
Yeah, I think that's an important, although I think that's a little bit of noise, I do think it's an issue that we should be aware of, and there's definitely jurisdiction risk happening as we see the value of resources increasing. Certainly, that would be the desperate need from governments to secure the capabilities of them using those resources as advantage of those countries, respective countries. Look, I think there's there's a lot of issues in the mining space, and there's a reason why we're seeing such a long period of time where allocation of capital has neglected this industry. Some of those reasons is public companies that shouldn't be public, junior businesses that should be really private companies, and too many segregated companies, meaning things have to be a little more consolidated to allow those major companies to be able to acquire land packages that are large enough for them to develop. It's making things very difficult right now, and so we've been certainly attempting to fix some of those problems. I think there's issues in the leadership of the industry as well. When you look at the producers, some of those companies are selling their assets. They're selling, non-core assets and potentially even gold assets because their shareholders are pressuring them to invest in battery metals and so forth. And so all those things are kind of unfolding recently. And I think those are important ones that to see how, this is just another sign of just overly conservatism, but also, the fact that we're not seeing focus towards gold at a time that you should be actually interested in the metal. And, not to mention the shareholder-friendly policies that we're seeing across most of the bigger companies, such as buybacks and dividends, to the degree that we haven't seen in the past, and also more than what we've seen usually in CapEx. Or capital spending for exploration and other, the new development of other projects that we haven't seen in a long time. So this is all translating into a lack of discoveries, lack of new supply, and delaying the process of seeing supply of those metals to become much larger. But it's, this is an opportunity from a standpoint of, as we both come from Brazil, I mean, understanding that Brazil will never change. It will always be a corrupt place and likely to have political issues and risk and so forth. But there are times in history you want to own those economies. You want to be exposed to those parts of the market. And those are times when you have, tangible assets being very favorable, inflationary periods. Those are times when you have commodities being in a cycle and so forth. And you kind of put away the prioritization, despite the fact that it still matters to political leadership. You put that a little bit on the side and focus more on the quality of those businesses as you see hard assets increasing, because they have an inherent pricing power. As we have hard assets appreciating, you tend to see those companies do very well on the back of that. This also, despite the fact that the cost of producing increases during those times. But you can see that natural resource industries perform really well during inflationary decades. So the focus should be there. If you check your boxes that we're in an inflationary decade, then you want to be also, allocating time and effort towards emerging markets that have commodity-related, companies and favorable commodity economies that can actually perform well in this environment. And there's no shortage of those. South America is one place. And as we see the prioritization of the market shift away from jurisdiction risk into potentially looking at how much time and effort would take for a South American project to go into production relative to a North American one, given the political issues that we have in developed economies, given the Green Revolution and other problems that don't allow those things to be advanced. And so as we see those things transitioning, I think people are going to start allocating more capital in those economies, and those are going to actually unleash a lot of great opportunities. So, I still think that there's ways to really express that view in markets right now, and Brazilian markets are certainly one of them, but South America overall looks quite attractive from my view.
So I guess that would be a way of playing the commodities sector would be going along emerging markets. And it's interesting, this relative value chart here. Yeah, this is the lowest it's been, I mean, in your lifetime. For me, I mean, I was born in 1964. That seems to have been the bottom there, which is interesting. So there's a lot of upside room there. And I guess playing the Brazilian ETFs or some Brazilian companies would, and also maybe even Argentina now with what's going on there.
Yeah, and it's important because there's, I think when you start talking about those things, people immediately talk about what about the communist threats that we have in with Lula leadership and so forth, and those things are real. I'm not trying to move away from those risks, and they're real risks. But there are times that it's the same thing happens with mining industry. The mining industry, you can always say and claim that those are capital intensive companies. They're very difficult and complex businesses to invest. They are, but there are times in history that they work. And we are in a particular time right now that I think it requires more due diligence into that space, because I think, given all we have going on in the world, deglobalization, reshoring of G7 economies, affordability of housing becoming a problem as we see more building of homes, green revolution and other things, it's hard to believe we're not going to see the metals and mining industry becoming a much more relevant segment of the overall economy. As we see that happening, that should create also demand for countries that have a lot of those the exposure towards those resources, and Brazil is one of them. And so, yes, there will be, there's a reason why Brazil has never emerged to become a developed economy. It won't be a developed economy at the end of all this. And so don't create those crazy plans in your head, but be aware that there's a lot of opportunity for expanding multiples, for the expansion of multiples of those companies as we see money in capital inflows towards those economies over time. And I really feel like that's going to be the case here. And there will be indirect parts of those countries that will perform very well. I often talk about the banks. Historically, the Brazilian banks have never been cheaper. They basically run oligopoly in the country. The very small players that basically form the entire market, and they've been established businesses for many decades, and they trade at a very low multiples, and they pay dividends and other things. And so there's other segments of the economy in Brazil that will also look very attractive. And you have the state-owned companies that are less attractive from a political aspect, but they are spinning off some of their assets, creating new oil companies and other things. And so pay attention to those. There's private companies being formed and public companies being formed on the back of those assets being sold. And so we've been certainly very focused in some of those things, and I think there's a lot more to do there. And this is going to be an opportunity that chart that you showed is basically the commodities to equity ratio chart, right? It's the fact that commodities are so cheap relative to financial assets. And, it's the same thing with the value to growth chart, if you looked into that. And so all those things are linked, right? Now, all those are thematic ideas that are probably going to be playing out in the near future, in the next 10 years, 5-10 years, that investors should be very focused on. It's value investing, is how do we approach this high multiples of technology companies with cost of capital staying higher? How do we approach the capital flowing out of those fixed income and 60-40 portfolios from fixed income and equities into other things like hard assets? As we see emerging markets doing well, particularly the ones that have favorable resource economies, gold doing very well in this next decade. And so all those things are kind of in the same playbook. And this is why, I often talk about them kind of linked.
A final question here, because you want to go and look at what the Fed does. And I know you look at the long-term picture, macro picture, 5-10 years, but could you just tell us what you think is going to be a major theme in 2024? And I know that's a difficult question, but I understand that there's probabilities, right?
Yeah. Well, I think the two things are going to be deceleration of growth, focus, shifting away from inflation to deceleration of growth, even contraction of growth. I think that's going to be a theme. Labor markets are going to be a theme, I believe. I think labor markets are going to deteriorate further and start showing some problems. As we see that happening, it's going to put the Fed in a very difficult position. And as the Fed reacts towards that difficult position I'm referring to, which means either cutting rates or not raising rates for a while, we may see on the back of that commodities doing very well. And that recreates the second wave of inflation. And so I think there's, the first half, I would say, contraction of growth is the first thing comes to mind. Second half, potential for a second wave of inflation reemerging. And if that happens, I don't think it's going to be positive for the economy overall. I think that's very stagflationary at its nature.
Yeah, and like you said earlier, if the Fed starts cutting, it's actually the beginning of a recession. So risk assets are going to be in trouble. And then if you get the inflationary wave, you want to be in commodities. So Tavi, thank you very much for your time. I wish you a very Merry Christmas and a Happy New Year.
Merry Christmas to you as well, Maneco. Thanks for having me again.
You're welcome.